And even if this means unemployment goes up a little bit, layoffs mount, so what? Jerome Powell actually wants that to happen. Hi guys, it's Stock Curry, and in some prior videos we talked about how we could not yet hit a bottom in the bear market until we got an earnings sell-off. Well, the earnings sell-off has started, and it's far worse than anybody could have predicted. You need to know what's going on, so let's get into it. Now, before we talk about the earnings sell-off that is underway, we need to talk about some more important news that came out earlier this morning. Elon Musk walked into Twitter headquarters earlier today carrying a sink. There's been a lot of question about whether or not Elon Musk would actually buy Twitter or not. He said today on Twitter, "I am entering Twitter headquarters. Let that sink in." Very punny, Elon. Very punny. Now on to some more serious news. Jerome Powell is once again facing political pressure as worries mount over the economy. Senator Brown is expressing concern about the impact that interest rate hikes could have on employment. He said political job losses brought about by monetary over-tightening will only worsen the inflation matters for the working class. Now, Jerome Powell has had political pressures before. But the one thing you have to understand is that here in the United States, our Federal Reserve is completely independent. They are not supposed to be swayed by political pressure whatsoever. The only thing they should be swayed by are economic indicators. The Federal Reserve has two mandates. One, get inflation down. Two, keep the job market strong. Now, some politicians are concerned that the Fed's fight against inflation by raising interest rates is causing unemployment to mount, and it's causing layoffs to increase faster and faster, which could cause the unemployment rate to rise quite significantly. However, in the past, Jerome Powell has said that they will continue to raise interest rates, and they expect the unemployment rate to rise. Jerome Powell has basically said that the unemployment rate is too low and that unemployment needs to rise in order for the economy to get back to a more normal level. So Jerome Powell is pretty headstrong on continuing to raise interest rates in order to get inflation down. And even if this means unemployment goes up a little bit, layoffs mount, so what? Jerome Powell actually wants that to happen. Now, there are some economic indicators Jerome Powell will look at in determining when or whether or not to start slowing down the rate of rate increases. And one of those is the 10-year 3-month Treasury yield. When the 3-month Treasury yield pays a higher interest rate than the 10-year Treasury yield, this is called an inversion. And when the 3-month and 10-year Treasury yields invert, it always points to a recession starting within 6 to 18 months, but most of the time within 6 to 9 months. And the 10-year and 3-month Treasury yield officially inverted today, with it now at negative 0.07. This has caused some people to speculate that the Fed will slow down the rate of rate increases, with the expected interest rate rise next week now dropping from 96% of the market expecting a 75 basis point rate hike to only 85% of the market expecting a 75 basis point rate hike. This now means that if the Federal Reserve does do a 75 basis point rate hike next week, that is no longer priced in, and the market could drop after they do so. And speaking of interest rates on Treasury bonds, Friday is the last day to buy I-bonds at a 9.62% annual interest rate. After Friday, the rate is expected to drop to 6.48%. You can buy those Treasury bonds directly from the U.S. government at treasurydirect.gov. That's treasurydirect.gov. Now moving on to the earnings sell-off. Alphabet just had its worst day since March 2020, with the stock down more than 9% in a single day. This after they reported revenue growth slowed to just Microsoft did not report much better, with its shares down 7% on the day. That said, in yesterday's video, I said put options would pretty much be a sure bet on Meta, and Meta reported earnings after the close today, and its share price dropped by over 19%. Meta shares plummeted on both an earnings miss and weak fourth quarter forecast. That headline is kind of nice. Wait until you see these numbers. It wasn't a miss. It was a downright disaster. Now, before we talk about exactly what Meta reported, you have to understand that estimates were already extremely low to begin with. Despite those extremely low estimates, Meta missed on earnings per share, reporting $1.64 versus $1.89 expected. And revenue was a slight beat, but those earnings were just absolutely awful, and it sent the stock down about 11% after hours. But it was what Meta said on the earnings call that caused the stock to drop from down 11% after hours to down 19% after hours. Operating income declined 46%. Operating margin sank to 20% from 36% a year earlier. Net income was down 52%. That's in one quarter. Income was down 50% in a single quarter. After dropping 19% after hours, Meta is now trading at its lowest level since March of 2016. That is a more than 6-year low on Meta's share price. And you might say, okay, well, that's because ad revenue went down. We kind of expected that. What about the metaverse? How are they doing on that? I'm going to tell you, but you're going to wish you had not asked. Its futuristic metaverse business called Reality Labs, its loss widened to $3.67 billion from $2.63 billion in the same quarter last year. Reality Labs has now lost $9.4 billion so far this year, and there's no end in immediate sight. Meta said, we do anticipate the Reality Labs operating losses in 2023 will grow significantly year over year. At this point, Meta is on track to lose $30 billion by the end of next year on a metaverse that, quite frankly, looks like it came out of an original NES game. It is awful. Facebook stock is tumbling, and I do expect it to continue to tumble for the next year and 3 months at a minimum. If you're wondering how Ford did, they revealed a third quarter net loss. Just like Meta, Wall Street's expectations for earnings were subdued. They were extremely low to begin with. Ford did manage to slightly beat those analyst expectations. Earnings per share came in at 30 cents versus 27 cents estimated, and revenue came in at $37 billion versus $36 billion estimated. Ford stock was down over 1% after hours. Now, with all of these earnings coming out and stocks tumbling left and right, you might be wondering what we can expect for Apple and Amazon earnings. They get reported Thursday after the close. Well, let's start with Apple for a second. We have enough information on both of these stocks to make a good prediction at this point. For Apple, we get a look at their sales of their iPhones, computers, laptops, tablets, things like that. And for that, we can take a look at Microsoft's earnings. Microsoft's earnings on the retail side of the house were down significantly. And so it does not look like Apple is going to have a good third quarter at all. In fact, we've already seen them lower their output production of their iPhone 14 just 2 weeks after releasing it. So I do expect Apple to have an earnings miss as well, and I expect that stock to go down. Now, when it comes to Amazon, there are two major sides of the house to Amazon. One is their AWS, their cloud services platform. When we look at Microsoft and Google, which both have cloud service platforms, both of their cloud service platforms have an increase in revenue. Now, that might sound like a good thing, but both of theirs also had a significantly higher increase in costs due to inflation. And unfortunately, the rise in costs from inflation exceeded the rise in revenues. So for both Microsoft and Alphabet, they actually saw a decline in their earnings from their cloud side of the business. So it does point to Amazon having a decline in earnings from their cloud side of the business as well. Now, the other side of the house for Amazon is their retail side of the house. And based upon Microsoft and Whirlpool and a few others, we can expect that Amazon's retail side of the house has probably gone down also. We will get a little bit better information on that when Shopify reports earnings Thursday before the open. That'll give us a little bit better insight as to how Amazon might report. But so far, with the information we have at this time, based upon the earnings from Microsoft, Alphabet, and Whirlpool, it's not looking good for Amazon at all. It looks like Amazon is also going to miss earnings and go down. Keep in mind that prior to Wednesday, Amazon had a PE ratio of 108. Now, that PE ratio has come down slightly after the 4% drop in the stock on Wednesday. However, it should be noted that Amazon's PE ratio is still about 40% higher than Tesla's PE ratio. And people gawked at Tesla's PE ratio at 60. Well, Amazon's got over 100 on their PE ratio. So Amazon, if that stock is going to go up after earnings, it is going to have to blow earnings out of the water. It is going to have the kind of shocking surprise earnings beat that Netflix had if it's going to have any chance of going up after earnings. The fact is, a PE of over 100 is not going to stand as we enter a recession and things continue to get worse. As always, we will be looking not only at Q3 earnings, but also at forward guidance. So far, most of the forward guidance has been bad. That's why we've seen stocks tank at the fastest levels in years. And it's very possible we could see that again with Apple and Amazon. In full disclosure, I do have put options on both Apple and Amazon in expectations of them missing earnings and the stocks going down. If you got a lot out of this video, be a good friend and share this video with your friends and family and on your social media. Click the like button and subscribe. And if you want some more details on how Alphabet and Microsoft reported earnings yesterday, make sure you go watch the video that I uploaded here.